Hello, welcome, good afternoon, good evening. Sincerely appreciate you all taking the time to join me today as we talk about merchandise operations and how to account for things like inventory. And I just want to first and foremost say thank you. I sincerely appreciate all of your hard work you're doing in the class so far. I know that this is not an easy topic for a lot of students. Accounting can sometimes be either boring or it can be challenging in most cases. Sometimes we have a fear of numbers. And hopefully, the way that I teach is helping you to overcome that fear of numbers. It is my goal to teach students accounting in a logical way. And that's why I try to go somewhat slow, do one chapter a week, provide you with that additional time to read and practice and do your work on Thursday. That's why I set the course up this way. And hopefully you see the value in that. But I just wanted to say thank you. I sincerely appreciate your hard work so far. All of you are working along, and I really like that. I love the fact that you're not falling behind and you're really trying your best. I sincerely appreciate your hard work. I do. Anytime you feel like you need help, I want you to know that I'm here for you. You can reach out to me. You can email me. You can call me. You can set up office hours. I'm here for you. Okay? I'm here for your success. And hopefully you see that. But again, thank you for your hard work. Okay, let's go ahead and talk about merchandising. I want you to think about your favorite retailer. Mine just so happens to be Macy's. Your favorite retailer might be Amazon or Walmart or Target or whoever. Who's your favorite retailer? Tell me. Where do you like to buy stuff from?
I like Macy's too, and some online stores.
Macy's and online stores? Okay, I'm with you on that.
I used to
Amazon.
work at Macy's.
Amazon, you did?
Yes, it was my second job, so it's like home, Pentagon
Awesome.
City.
Awesome. I love that. Very cool. You'll definitely get a kick out of this. What else? We got Macy's. We got Amazon.
Tyson's Corner. I love Tyson's Corner. Just everything about it.
Okay. All right. I like that. Very cool. Okay. So keep that favorite store in mind. And for those of you who have ever worked in retail, I used to. I worked in retail. I worked at Sears a long time ago. Most of you probably remember that store. They're not really around anymore. I also worked at a couple of other retailers. Starbucks. They're kind of more a service business than they are retail, but you get my point. Think of your favorite retailer, and if you've ever worked in retail, TJ Maxx. Oh, that's a good one, Portia. Think of your favorite retailer, and if you've ever worked for them or a retailer, think about what it was like. Dealing with merchandise, right? The inventory, ringing up customers, providing customer service, putting away the inventory. Maybe you did some stock, yeah, right? You counted all the items on the shelves, or something, right? That's what I want you to think about today, because I promise it'll help you. So we're going to talk about what retailers do. We're going to talk about their business, how they account for inventory. We'll also talk about the cost flows. And of course, we'll end with a couple of your favorite ratios. In the meanwhile, we'll also talk about the inventory systems and how retailers track their inventory. I promise I'll try to make it fun and entertaining for you. So, as you know, retailers earn their revenue sales. From selling, inventory, merchandise. The word merchandise represents inventory. We call a retailer a merchandise company. It's a company that sells inventory. Let's talk about the income statement. The income statement, as you know, is one of the four primary financial statements in accounting. The income statement represents sales, which is your revenue, and it also shows expenses from the day-to-day operations of the business. And at the very bottom, there's a line item called net income. To find net income, it's the difference between sales and expenses. So on a income statement for a service company, you'll see sales, expenses, and net income. And in reading that income statement, at the top you'll see sales, in the middle you'll see the expenses, and at the very bottom you'll see net income. To find net income, we take sales, revenue, minus expenses to equal net income. Okay? You'll notice that there's a couple of things missing on this income statement, and that's the difference between a merchandise company, retailer, and a service company. And that line item, we call that cost of goods sold. A service company does not sell products. They sell the service, right? This would be a law firm, an accounting firm, plumbing services, a lawn care business, a barber shop, a hair salon. These are all service companies. They provide a service. They don't sell you a product, right? They provide the service. And so, service company, you'll see revenue, expenses, net income on the income statement, and that's all you'll see. What's missing is a line item called cost of goods sold. We're going to talk about that. Cost of goods sold is here in a merchandise company, retailer. Cost of goods sold. The name of the account is exactly what it means. It's the cost of the inventory that you have sold to your customers. It's what it costs you, the business. It's the cost of selling that inventory. That's what cost of goods sold represents. On an income statement for a retailer, we're going to have sales, call it merchandise sales, typically. And just below sales, we're going to have this line item called cost of goods sold, which represents the cost of selling the inventory. And below that, we're going to have a new line item called gross profit. This represents your profit before all of your expenses. That's why they call it gross profit. And then at the very bottom, you'll still have net income. So we can see the difference between a merchandise company and a service company. The two line items that are different, of course, are cost of goods sold and gross profit. Those belong to a merchandise retail company. You will not find those two items for a service business. So the income statement kind of follows a formula, doesn't it? We got sales at the top minus cost of goods sold equals gross profit, and then minus all of your expenses equals net income at the bottom. The word net income, of course, is derived from net of all of your business transactions. That's what net income means. It's what's left over after the day is done, after the month is complete. At the end of the year, did you make a profit or a loss? That's why they call it a profit and loss statement sometimes. It tells us, did the company make a profit or a loss? If we have net income, that typically means we have a net profit. If it's a net loss, it'll be called net loss instead of net income. That's where these terms come from. Here at the bottom of the slide, you can see the comparison between the service company and the merchandise company, or the retailer. Nordstrom, for example. And Liberty Tax, the tax, they do people's taxes, right? Liberty Tax. H&R Block, if you will. We see that the H&R Block on the left, they have revenue, expenses, and then net income. There's no cost of goods sold or gross profit because they're just providing a service. They're not selling a product. On the right, we have Nordstrom. We have sales minus cost of goods sold equals gross profit minus the expenses equals net income. So it's important to understand the difference between the two and keep that mindset of the retailer, because over the next 30 minutes or so, that's what we're going to be talking about. So let's focus on the one on the right. So I'd mentioned cost of goods sold comes from the cost of selling the inventory to the customer. And it's important that we know what inventory is and how the cost flows through the retailer. If I wanted to sell products, I would need to first buy those products to sell them. Unless I'm a manufacturer, I could make them myself. But I'm not too much into manufacturing. That's challenging. I'm into buying stuff and selling stuff. Okay? So, let's say Dr. B, he really likes calculators for some reason. And I just so happen to have a calculator here. And I sell calculators. So the way it works is I need to buy calculators in order to sell them to other people. So what I'm going to do is I'm going to submit what we call a purchase order. Step A. I'm going to submit a purchase order to Texas Instruments for the purchase of 100 calculators. A variety of them, okay? And Texas Instruments then says, okay, no problem. We'll send you the 100 calculators. So step B, I'm receiving the calculators that I have purchased. Okay, from my purchase order. When I receive my inventory in part B, I also receive a bill, an invoice from the purchase. And that invoice tells me the quantity of the inventory that I purchased, 100 calculators, a description of the calculator, and then a price or cost per calculator. And then it'll give me a total at the end, right? So if I bought 100 calculators at, we'll say, $20 a piece, that's $2,000 worth of calculators I bought. And so I owe that money to Texas Instruments. So what I do, of course, is create an accounts payable for Texas Instruments. So I debit inventory calculators to increase my inventory. And I credit accounts payable because I owed my supplier, Texas Instruments, $2,000. And then what happens is eventually I'm going to sell them calculators. Okay. What am I going to do with 100 calculators? I'm going to sell them. So I start selling through the calculators. And as I'm selling the calculators to my customers, I'm either selling them for cash up front because they came in, they saw me, they bought the calculator from me, and they left. They gave me cash. Or I might have a customer that'll say, you know what, I'll buy a couple of these from you and I'll pay you later. Meaning they're going to buy it on accounts receivable. So let's say, since I bought these calculators at $20 a piece, I need to make a profit. Okay, that's why I'm here. That's why I sell things. I need to make a profit. So I'm going to sell each calculator for $100. It cost me $20. I'm going to sell it for $100. Okay? So let's say I have a customer that comes in. They buy the calculator from me using cash. Okay, Dr. B, here's $100. I said, great, here's your calculator. So that's a sale. What I do is I debit cash $100 and I credit sales $100. But I'm not done yet. There's a second transaction I need to enter. The second transaction is I need to reduce my inventory. Because I sold a calculator, right? So how do I do this? I debit cost of goods sold, $20. I debit cost of goods sold, $20. Reason why? I need to recognize that I sold inventory. I sold a calculator. It cost me $20 each to buy. I sold it for $100. So the first transaction, I received the cash from the customer. Debit, $100. Credit, sales, $100. Second transaction, I debit cost of goods sold, $20. Remember, it cost me $20 to buy it. I need to recognize the fact that I sold it. So I debit cost of goods sold, $20. I credit inventory, $20. So what that does is it increases cost of goods sold and it decreases my inventory. You see, so for every single sale of inventory that we make, there's actually two transactions involved. One is you recognize the sale, and two is you recognize the cost of goods sold and reduce your inventory. This happens at the very same time. Now, of course, with modern technology, when you go to Macy's or you go to Nordstrom, at the register they have that little scanner. Okay? They scan the barcode. As soon as this barcode gets scanned, the computer takes the merchandise inventory out of inventory and it puts it into a sale. You see? So that happens automatically when you scan the barcode. But I'm walking you through the process manually so you understand how it works. So if I make a sale to a customer on account, meaning they pay me later, eventually I'll collect the cash from them. And then I do it all over again. Send another purchase order to my vendor. They send me more inventory. I pay my vendor. I sell my inventory to my customers, collect cash, and then I do it again, right? So it's a cycle. Yep. Over and over and over. That represents the merchandise cycle. Inventory can be somewhat complex sometimes. Okay, sometimes it's hard to know what I have available for sale, especially if I'm a big store. Okay, you got a big store like a Macy's or Nordstrom or, again, your favorite retailer. You got a lot of different products. Okay, thousands sometimes, right? You know, think of like Amazon. They got millions of different line items, SKUs, a lot of different products. Millions. You got hundreds of thousands at somewhere like a Walmart. You got over 100,000 at Macy's. Same with the Nordstrom, right? It's difficult to track that. And so we use what's called an inventory system to know what we have available. Okay? And so here's the formula for it. We take our beginning inventory. That's what we started the month with. I did my physical count, okay, what I have on hand. And that becomes my beginning inventory at the beginning of the month. Plus purchases. Purchases represents the purchase orders, which became invoices from my vendors. I purchased more inventory from my vendors. Okay? So beginning balance inventory plus purchases equals merchandise available for sale. This represents what I have available, okay? What I can sell to the customer now. Another way to find your merchandise available for sale is to take your ending inventory balance. That's what's left over at the end of the month. The inventory I have left on my shelves at the end of the month, that's my ending inventory balance. Plus cost of goods sold. That tells me my current merchandise available for sale. So there's two ways to do this. It's kind of like working backward or working forward, you know. Either way, you come to the same conclusion. Now, there are two primary ways of tracking your inventory. The most commonly used method is called the perpetual inventory system. The perpetual inventory system is used by large retailers like Macy's, Nordstrom, Walmart, Target, etc. And even your local 7-Eleven or whatever your favorite corner store is. They use the perpetual inventory system because it makes it easy to track the purchase and sale of all of your merchandise. The reason why they call it perpetual is because it's continuous. That's the word perpetual means, continuous, yeah? And perpetuity, continuous, yeah? Perpetual inventory system updates every single time we make a sale or make a purchase. How it works? The scanner, yeah? The scanner scans the barcode. It automatically updates the inventory for those items. When I scan a barcode, it takes that inventory out, right? Because I'm making this sale. So it automatically updates continuously, yes? So when you think perpetual inventory, think updates every time we make a sale or make a purchase. It's almost automatic. So we use barcode systems for perpetual inventory system. The other kind of inventory system is manual. And we update it every once in a while. That's why we call it periodic. Now, the periodic inventory system is used by companies that do not have a whole lot of sales every day. Or maybe they're big ticket items. They don't sell a whole lot of those. An example of a company that would use the periodic inventory system would be a car dealership. A car dealership uses a periodic system because they can go and physically count how many cars they got on the lot. And they do that every couple of days or once a week maybe or once a month. It's easy to count cars on the lot. Okay? You just go outside and you track them. There's no barcode reader at the dealership. Okay? They count the cars. It's a manual process. They update the accounting, the inventory usually at the end of every month to keep track of what's there. It's periodically, and that's why they call it the periodic system. So anytime you're wondering the difference between the two, perpetual system, think continuously updating. Yeah, barcodes. For the periodic system, think physical counts at the end of each month. Dealership. Now, I'm going to go through a couple of examples with you using the perpetual inventory system. And these examples, you'll see how we record the transactions. It's very similar to the examples I gave you earlier by explaining that there are two transactions for every single sale. First, we recognize the cost of the inventory, and then we recognize the sale. Two different transactions, but we do them together. Well, let's take a step back. I'm going to show you a lot of different transactions. This first transaction here is us, our company. Well, let's say we're 7-Eleven, okay? 7-Eleven, we're going to sell some candy on our stand in front of the register. And I need to buy some candy to sell near the register. And so what I do, I contact my vendor and I say, hey, I need a variety of candy, $500 worth. So they come, they deliver the candy, and I pay them right away with cash. So now I have candy to sell. So first thing I do is I debit my inventory. It'll be inventory candy, keep it specific. So debit inventory candy, $500. That debit increases my inventory. Remember, inventory is an asset. I use assets to help the business to generate sales, right? That's why inventory is an asset. More specifically, it is a current asset on the balance sheet. So I debit merchandise inventory candy, $500. And I credit cash, $500, because I paid cash for the purchase. Oh, and also point out, I did not get a discount from my vendor when I purchased the candy. Reason why? I don't know. This particular vendor, they don't want to do discounts. No problem. So I'll show you without a discount and with a discount. Kim, please.
So, is the merchandise inventory and the cash is always gonna match?
Most of the time, yes, unless there is a discount,
Okay,
which is what I'm about to show you.
okay, thank you.
You're very welcome. So here we have a discount. And I'm going to show you, this is a series of transactions involved with a discount. First is, I purchased $500 worth of candy inventory on account, and the vendor gave me what we call credit terms. Credit terms is a nice way of saying discount. The discount is not automatic, though. The way discounts typically work in business from your vendor is if you pay them fast, they might give you a discount. That's what terms mean, yeah? If I pay them fast, they'll give me a discount. Here is a term. This is probably new to all of you. The terms are 210 net 30. 210 net 30. I know, kind of confusing, right? Here's how we interpret this. Remember, the definition of an accounting is it is a language of business. So we interpret things. Here's how it works. I purchased $500 of candy from my vendor. The vendor said, hey, you know what, Dr. B? I'm going to make you a credit terms. Okay, sounds good. What are the terms? The terms are, I will give you a 2% discount. That's where the 2 comes from. I'll give you a 2% discount if you pay me in the first 10 days. That's where the 10 comes from. Otherwise, the entire amount is due within 30 days. Net 30. I'm going to say this again, okay? So you'll learn how to read these types of things. I'll give you a 2% discount if you pay me within the first 10 days. Otherwise, the entire amount is due within 30 days. That's what 210 net 30 means. I get a 2% discount if I pay within the first 10 days. Otherwise, the entire amount is due within 30 days. 210 net 30. Now, it's important to also understand that these credit terms are not always going to be the same. They might be the same with specific vendors because it's based on whatever deal you negotiated with that vendor. You might have a vendor that gives you real favorable terms. It might be like 5% within 10 days, otherwise the whole thing in 30 days. It could be whatever. It could be whatever percentage off. That depends on the negotiated deal that you made between your company and your vendor. Make sense? Are we all good so far? Do we understand 210 net 30? Okay.
Yes.
Great. Thank you so much, Paulette. Okay. I see a lot of thumbs up. Thank you, Maxine. Okay, great. So that's the first transaction is I record the purchase. I raised my inventory amount by debiting inventory. And I credit accounts payable, $500. Here's why, okay? I credit accounts payable $500 because I don't know if I'm going to pay them within the first 10 days or not. So record for the full amount. So the discount percentage is that first number, 2%. I get a 2% discount if I pay within the first 10 days. Otherwise, net, the whole amount is due within 30 days. 210, not 30. This is the negotiated credit terms with my vendor. Credit terms are typically negotiated up front with your vendor, and the deduction from the invoice is based on your ability to pay early. If I pay within the first 10 days, I get a 2% discount. The discount period is 10 days. Otherwise, the whole thing is due within 30 days. It's a nice graphical way of looking at it. Here's what a typical invoice looks like. Sold to, name of your company, address, all that good stuff. Your vendors, number 1. The date of the invoice. Number 2, invoice date is really important. When you're entering the invoice date into your accounting software, QuickBooks, Sage 50, Oracle, whatever. When you're entering the date of your invoice in, make sure that you use whatever date is written on that invoice. Dates are very important in accounting. And the reason for that goes back to the matching principle. Remember, the matching principle says that I need to record expenses that match the time the revenue was earned, right? So that's why it's very important that we record the accurate dates. Number 3 is our information. Number 4, also important, the purchase order date. When did I contact my vendor and say I needed this inventory? So purchase order date, number 4. Number 5, the terms. These are your credit terms. 210 net 30. 2% discount if I pay within 10 days. Otherwise, the whole thing is due within 30 days. Number 6. Oh my goodness, most students get confused about these terms. Number 6 is called freight terms. This particular invoice says free onboard destination. Here's what freight terms means. The freight terms tells the buyer who is responsible for the inventory while it is in transit. Okay, that's really important. Here's why. If I purchase something from my vendor, I need to know who's responsible for it while it's in transit. If that truck rolls over and catches fire, who's paying for that inventory? Okay, I don't want it to be me. I want it to be the person who sent it to me. That's why the freight terms are really important. Think about like the last time that you moved from house to house. Or think about the last time you bought something online and had it shipped to wherever you're living. Yeah? Who's responsible for it? Is it you, the buyer, or is it the person that sold it to you? Okay, if it gets lost, the postman loses your package. Well, are you going to be able to get a refund? I don't know. We don't know the answer to that question. The answer to that question lays within the freight terms. If it's free onboard destination, that means the person that sent it to you is responsible for it. If it's free on board shipping point, you're responsible for it. Okay, so that's why it's important that we know freight, and we'll talk more about this. Number 7 shows us what we ordered, the quantity, the price of each individual, and the total amount. Sometimes the price and amount might be different. Why? Because it's based on the quantity. If I bought 2 at $150 a piece, then I know I'm going to be paying $300. You'll have your subtotal, if there's a shipping cost, if there's any tax involved, and then the total amount. And then number 9 will show the net of discount. Now let's break this down, okay? Nice and easy. The net of discount amount shows what I would pay if I paid it within the first 10 days. So instead of paying the full $500, if I want to take advantage of this 2% discount within the first 10 days, then I'll only have to pay $490. Okay, that's what that tells me. And you could, of course, you could easily figure this out with a calculator, right? $500 times 0.022%, that's $10. The discount amount is $10, yeah. Okay, so that's what your general invoice looks like. Let's look at the transaction, okay? And Kim, this is what you were asking about. So the answer is most times yes. The inventory amount will be the same as what you paid for, but in some cases no, if there's a discount involved. And so this is what this looks like. The first transaction, I debited merchandise inventory $500, and what did I do? Silly. Sorry. I debited merchandise inventory $500, and I credited accounts payable $500. That was the first transaction. Now here we are, the second transaction. I'm getting ready to pay this bill, and I'm going to take advantage of that discount. I like a good discount. Believe me, y'all. If there's an opportunity for a discount, take advantage of it. Anytime we can save money, we do it. So I'm saving money. I'm saving $10. You better believe it. So I debit accounts payable $500. Here's why. Because that original bill was for $500. I have to reduce it by that whole original bill. Otherwise, there's going to be a $10 balance sitting in accounts payable, and that ain't going to look right. Okay. Your credits won't equal your debits won't equal your credits if that's the case, yeah? So that's why we debit accounts payable $500. And then I'm going to credit merchandise inventory $10. The reason why I credit merchandise inventory $10 is to reduce the cost of my inventory by $10. Why would I do that? Because I received a discount of $10. I need to recognize that the inventory didn't actually cost me $500. It only cost me $490. So I need to reduce my inventory by $10, my inventory cost. So to do that, I credit inventory. And then I credit cash, $490. Why $490? Because I got a $10 discount, 2%. $500 times 0.02, that's $10 discount. So that means I would actually pay $490. Does that make sense? Are there any questions on this topic? We're good. Kim, how did I do? Did I answer your question? We're good. Okay. This is what it looks graphically with your ledger accounts. Remember your T accounts. We call them ledger accounts. This is what it looks like graphically. So you can see November 2nd, I received the bill $500. November 12th, I paid it. So I reduce it $500. I reduced my merchandise inventory on the same day by $10. That's the discount amount because we have to represent the actual value of the inventory. So if I receive the discount on the inventory, I reduce it by that discount amount. And of course, I reduce my cash by the $4.90 I actually paid. Now, what happens if I miss that 10-day window to get the discount? Well, you owe the whole thing. Remember, the terms were 2% discount if I pay within the first 10 days. Otherwise, it's net amount in 30 days. Okay, so after the first 10 days had passed, oh my goodness, I missed the discount amount. In that case, I just pay the full $500. So I debit accounts payable $500 and credit cash $500. Outside the discount period. I missed that 10-day window. Dang. Gotta get better with that. Okay, oh my goodness, my retail friends. These two topics, they give me heartburn. Oh my goodness. Oh, my heart breaks every time I see these two things on my, oh my goodness. Oh, you know what I'm talking about. Purchase returns and allowances. Oh my goodness. Now, in business, we know nothing is perfect. We wish it was, but it's not. A couple of things. Sometimes your customers, they might not like the stuff that you sold them. So they return it. Or maybe I, the business, receive some stuff from my distributor and I don't like it, so I send it back. We call this a purchase return. The merchandise has been returned by the purchaser to the supplier. Sometimes our customers come back and they bring stuff back. Oh, I'm so sorry. Right. Call that a purchase return. They bring the merchandise back to you. Hopefully unused. Hopefully not damaged. Call it a purchase return. The other one's called a purchase allowance. Now, sometimes I might receive a shipment from my supplier. Let's say we're that mini mart, okay? We're 7-Eleven. And my supplier, they brought some candy to me. And I open up the box, and what do you know? Half of your candy bars are broken. Oh, nobody likes a broken candy bar. So you call your supplier, okay, your distributor. You say, hey, distributor, you guys sent me a box full of candy bars. Half of them are broken. First, they might laugh. But then they'll say, okay, Dr. B, no problem. What if I give you a price reduction and you can keep the candy bars and sell? Okay, that's acceptable to me. I appreciate it, Mr. Distributor. Appreciate you. Give me the discount. So you get a discount on a future order with them, or they might just send you like a small check, something like that, right? We call that a purchase allowance. It's a price reduction for the defective or unacceptable merchandise. And that price reduction might either be on a future purchase that you'll make with them, or it'll be in the form of like a credit, yeah? Or it might be in the form of a small payment to you. So a couple of examples of these things, the purchase allowance. So our company, 7-Eleven, we issued a $30 debit memorandum for an allowance for defective merchandise. What this means. Our company, we purchased some inventory from Trex. So that's our candy supplier, Trex, not the deck company, the candy bar company. So they sold us some candy bars. Some of them were broken. We called them up and said, "Hey, $30 worth of this $500 orders is no good." They said, "No problem. We'll give you a discount on your next order." We call this a purchase allowance. So we debit accounts payable $30. What this does is it reduces the amount that I owe them by $30. They're giving me a discount, basically, right? So it reduces that, because originally, remember, it was $500 that I owed them. It reduces it by $30, because $30 worth of it is defective. And I need to reduce my inventory by that same amount. Yeah, because the inventory is now worth less. $30 less to be exact. So credit inventory, $30. Oh my, purchase returns. Purchase returns, here we go. Our company, 7-Eleven. We purchased $250 worth of merchandise on June 1st with credit terms of 2% discount within 10 days. Otherwise, the entire amount is due in 60 days. That's nice. Those are good terms. On June 30th, we returned $50 of those goods before we paid the original invoice of $250. Because we found that some of our stuff was defective, so we sent it back to them. Okay? Or maybe we over-purchased, so we sent some back. On June 11, we took advantage of the 2% discount on the remaining balance. Okay, so 3 different transactions, right? First transaction is we made the purchase. Debit inventory, $250. Credit accounts payable, $250. Terms 210 at 60. 3 days later, we're unboxing our inventory and we realize, hey, you know what? We bought too much. Let's send $50 worth of it back. So we debit accounts payable, $50, to reduce the amount that we owe them. And we credit inventory $50 because we're sending it back to them. Sending it back to the supplier. And on June 11, within the 10-day window, I still want to take advantage of the 10% discount. But it's not 2% of $250, because remember, I sent $50 of it back. It's based off of the remaining balance, which in this case is $200. So I take a discount of 2% from the 200, right? So 200 times 0.02 is a discount of $4. Okay. So we credit the merchandise inventory $4, and then we credit cash $196. Make sense? We're doing okay so far? Great. Awesome. Thank you so much. Okay, let's go back to that conversation we were having about who's responsible for the shipping. I tell you, this is so important. The reason why I say this, the reason why I'm bringing it up again, this has happened to me. I don't know if it's happened to you, but it sure as heck happened to me. Sometimes your stuff might get lost in transit. FedEx will say, "Oh, I'm sorry, Dr. B, your package is lost." What do you mean lost? Pardon me? What do you mean you lost it? How did you lose it? There's a barcode and everything. Oh, goodness. It happens. life happens. You know, you ship a product to a customer and FedEx loses it. Well. And especially if the customer's on the hook for it, if I'm on the hook for it, it's a problem. That's why we have insurance. But I want to explain that's why it's so important that we know who's responsible. So, two terms. First is free on board shipping point. This is where the seller sends the goods to the buyer, the destination, and the buyer is responsible for the goods while it's in transit. We call it free onboard shipping point. It means the buyer is responsible for it while it's in transit. It also means that the buyer is the one paying for the shipping. Okay? They're responsible for it. They own it while it's in transit. So if you've ever paid shipping for something you purchased on a website, Macy's.com, maybe you purchased something on Amazon and had to pay shipping for it, that means it was free on board shipping point. You were responsible for that product while it was in transit to you, the buyer. In this case, the company records the transaction like this: debit merchandise inventory and credit cash. Yep. The other term is called free on board destination. This means that the seller is responsible for that inventory while it is in transit. The transaction here that the seller records is a debit, delivery expense, and credit cash. Pretty straightforward, but really the important takeaway here is who's responsible for it while it's in transit. Transportation costs are oftentimes a large cost for retailers because oftentimes the retailers have to pay for the cost of the inventory to arrive at the store. They're purchasing it from a distributor, but they also have to pay the cost of getting it from the distributor to the store. The shipping costs. Yeah. So here we have an example. 7-Eleven. Purchase merchandise on terms free on board shipping point. Remember, that means the customer is responsible. That means we're responsible, right? We're the buyer. So the transportation charge is $75. The journal entry I make is I debit merchandise inventory and I credit cash. Here's why. Freight costs are a part of cost of goods sold. They represent the cost of inventory. Cost of inventory is not just the purchase price of the inventory. It's also the cost of getting it to you, the cost of any insurance that might be involved. We call it the landed cost. The landed cost. The landed cost represents the purchase price plus the transportation cost plus any insurance or anything like that. We call it the landed cost. It's the cost of getting it to you. So we debit merchandise inventory to increase the cost of that inventory, and we credit cash. Itemized costs of purchases. This just shows us the total cost of the inventory. Okay? It's the cost of purchasing that inventory minus any discounts. Okay? If I paid within that first 10 days, I got a discount, right? So we have to subtract the discounts from the cost of your inventory. And also minus any returns or allowances. If I send some inventory back, I need to reduce the total cost of my inventory by that amount. Plus cost of transportation, plus any insurance that might be on that, whatever, equals the total cost of inventory purchases. Make sense? Good. So I showed you a lot of like really good examples about discounts and transportation costs and returns and all those fun things. But now I want to show you the sales side. When we make sales, we record those sales transactions using either perpetual or periodic inventory system. Let me show you what it looks like with perpetual system. This is the barcode reader. Yep. When we make the sale, we scan the barcode. The customer pays us at the register. We debit cash, credit sales. First transaction. Second transaction, debit cost of goods sold, credit inventory. Yeah. Remember, there's 2 transactions for every sale that we make when we sell inventory. To compute gross profit, which is on our income statement, we take sales, net sales, right? But when you hear net sales, it's the sales amount after all of your discounts, returns, and allowances. So net sales minus cost of goods sold equals gross profit. So every sale involves 2 parts. We recognize the sale and we recognize the cost of goods sold. First transaction is the sale. I debit cash or accounts receivable. I sold an account. And I credit sales. The second transaction is I recognize the inventory. I debit cost of goods sold and I credit inventory. This is what this looks like again. Here's just an example of this. Our company, 7-Eleven, sold $1,000 worth of merchandise on credit. It's fine. Doesn't matter. It's still a sale. The customer will pay me later. The merchandise has a cost of $300. So I debit accounts receivable, $1,000. I credit sales, $1,000. First part of the transaction. Second transaction, debit cost of goods sold, $300. I credit inventory, $300. You see? Now, discounts work the same way when you sell to a customer. Your customers will be inclined to pay you back faster if you offer them a discount, if you offer them credit terms. Just like our vendor earlier who gave me those wonderful terms of 210 net 30, 2% discount if I pay within 10 days, otherwise all things due in 30. You, the business, can do the same thing for your customers. You can offer them similar terms. You can say, hey, customer, I'll give you a discount if you pay me within the first 10 days. Great, give you 2% discount. Awesome. You see, it works the same way. So here we go. We offered our customer credit terms, 2% discount if they pay within the first 10 days. Otherwise, they was the full amount within 45 days. So if the buyer pays within that first 10 days, they're going to pay us a total of $980 in cash. So we debit cash, $980. And then we debit another account. It's called sales discounts. Sales discounts, how do I want to describe this? It is a temporary asset account. It's a temporary asset account. So it's technically, let's call it a temporary, I don't want to call it an expense. It's kind of not that way. It's a temporary account, okay? And it provides you with cumulative amount of discounts throughout the year. Yep. So we debit cash, $980. Debit sales discounts, $200. And we credit accounts receivable, $1,000. Yeah, that's if the buyer pays within the first 10 days. Otherwise, it's real simple. We debit cash, $1,000. Credit accounts receivable, $1,000. The whole point of offering those credit terms to your customers, it encourages them to pay you faster. Yeah, businesses need cash to survive. If they don't have cash on hand, they're not going to last very long because they use cash for their day-to-day operating expenses. Yep. You might also offer your customers, oh my goodness, sales returns and allowances. If you're a good retailer, you might offer this. So your customer might return something to you. Why do retailers offer these things, returns and allowances? Well, they do it to keep their customers happy. You know, oftentimes if I go to a place and I buy something, let's say I buy a piece of clothing from Macy's and I try it on. And, you know, Dr. B gained a few pounds. It don't fit right. So I say, okay, let me bring it back to Macy's. Because Macy's has this thing called a return policy. And as long as I return it and it has its tag still on it, they'll give me a cash refund or however I paid, right? Or they might give me a store credit. You know, depending on whatever the policy says. The return part, if they just take it back and they give me my cash back, that's a return. If they give me store credit, it's kind of like an allowance, right? Because I have to spend that credit there. Yeah. Or sometimes, and a lot of retailers are doing this now, is they'll say, hey, you know what, keep it. We'll just give you a reduction in the sale price. We'll give you a little bit back. Right? That's part of allowances. But what I'm trying to say is, you, the business, you might offer this to your customers as well because it keeps them happy and keeps them coming back. Here's a couple examples of this happening. We got a customer that came back to 7-Eleven with merchandise which we sold for $15 and it cost us $9. So we're going to do a straight refund. No problem. The merchandise is perfectly fine. We'll put it right back on the shelf. Great. So what we do is we debit an account called returns and allowances. Yep, so what that does, this returns and allowances account, it's another temporary account. It's kind of like a, how do I want to describe this? It's kind of like a negative asset account. And it's called sales returns and allowances. And what it does is it provides you the ability to give cash back to a customer without having to reverse a transaction. Okay? So we debit sales returns and allowances, and we credit cash to provide the customer with a refund. We're also going to need to return the inventory. If it's not defective, we debit inventory and we credit cost of goods sold. We reduce the cost of goods sold and we put the inventory back. If the goods are defective, meaning, hey, this is broken, I'm not going to be able to resell this, what we would do is debit merchandise inventory if some of it is salvageable. We debit loss from defective merchandise, and we credit cost of goods sold. That's if it's defective, yeah. And sometimes we might offer a customer an allowance. Let's say a customer had $40 of merchandise from 7-Eleven. On November 12th, it's defective, but the buyer decided to keep it anyway. So what we would do is, hey, we're going to be really cool and just give you $10 back. An allowance, yeah? So we debit returns and allowances and credit cash. We talked about this concept called adjusting entries. I think it was like maybe 2 weeks ago now. And we also talked about closing our temporary accounts through the closing process. And then I believe that part was last week. So in retail businesses, we use adjusting entries, and we always close out our accounts at the end of every accounting period. It works very similarly when we talked about this the past 2 weeks. So one of the first things we do is we reconcile our inventory. And to do that, we take our beginning inventory plus our purchases to equal merchandise available for sale. And then if we take our ending inventory plus cost of goods sold, we can find merchandise available for sale. When we have cost of goods sold, that goes on the income statement. Our ending inventory is what ends up on our balance sheet as the ending inventory for, the ending balance of inventory. That's on our balance sheet. Our ending inventory becomes the beginning inventory for the next month, right? So January 31 rolls around. I have a balance of inventory on hand for February 1st. That becomes my beginning inventory. And I go through the whole cycle again. I do this every month. We make adjusting entries sometimes for our inventory. Sometimes stuff goes missing off our shelves, or it gets broken. I've dropped like a whole thing of, I break things. Not intentionally, but sometimes I might knock something over. Or a customer might kind of put something in their pocket. We have to make adjusting entries for this type of thing. Shrinkage represents the loss of merchandise. Losses happen either because we broke it, or because a customer stole it. So we need to record that loss. And to do that, we debit cost of goods sold and we credit merchandise inventory. This helps us to adjust. At the end of the month, we need to close out our temporary accounts, just like before, right? We do this for every company. We do this at the end of every month for every company. This is how we close out our income statement to get it back to zero for the next month. So on January 31 of this year, at the end of this month, oh, wait, we're in February now. Okay, so last month in January, I made these transactions. I debit sales and I credit it to income summary. Remember, income summary is that temporary account that helps us to close everything out. So debit sales, credit income summary, that transfers our sales to our income summary account. And then I need to close out all of my expenses, right? So I debit income summary and then I credit all of my expenses. And then, of course, I need to close my income summary to my equity account. So total income summary goes to the equity account. And then minus any withdrawals. Yeah, that's the closing process. You know that. We talked about that last week. When we look at an income statement, that income statement can be formatted in a few different ways. For a service business, it's usually a single-step income statement. For a service business, it's usually a single-step income statement. It shows your sales, expenses, and net income. We call it single step. Very little detail, just kind of like the overview, yeah? For retailers, we have what's called a multi-step income statement. That's where we have sales minus cost of goods sold equals gross profit minus your operating expenses equals income from operations minus your non-operating expenses equals net income. Multi-step. That's what I'll call a multi-step income statement. This format is the most common for the income statement for retailers and manufacturers. Single step, very simple. Revenue minus expenses equals net income. Very easy. But you'll notice the difference between the two. Multi-step shows all the detail. We see that net income is the same. Whether you use single step or multi-step, your net income is going to be the same. Your sales will be the same. Your expenses are the same. The difference here are those steps, the gross profit, income from operations, non-operating income. That's the additional detail. That's the difference between the two. I always prefer the multi-step income statement format because I can make decisions easily based off of this information. On your balance sheet, as you know, shows assets, liabilities, and equity. And we classify that information. Current assets, remember, 12 months or less. Non-current or long-term, greater than 12 months, sometimes called fixed assets. It follows an order of liquidity. Liquidity means how quickly I can convert something into cash. And that's why your assets always starts with cash. It's the most liquid. And then it goes accounts receivable, inventory, supplies, prepaids, right? It's organized in the what we call order of liquidity. That's why cash is always first on every single balance sheet you'll ever see. As managers, we need to do very quick computations sometimes to understand the financial health of the business and to know how well I'm using my assets to generate sales. So here are a couple of examples of these types of ratios that I as a manager would compute to get a real quick idea. One's called the acid test ratio. And this shows us how liquid our company is. So we take quick assets divided by current liabilities. Quick assets are assets that we can quickly convert to cash. This includes cash, short-term investments, and accounts receivable. So cash, short-term investments, accounts receivable divided by current liabilities gives us the acid test ratio. Usually a value of 1 would tell us that the company is doing well. It's liquid. 1 or better. 1 or higher. Here's the example for Nike using the acid test ratio. 1 or better is good. Looks like Nike's in a good place. And lastly, another very important ratio to compute is called the gross margin ratio. This tells us how profitable the company is. Really important. To figure this out, we take our net sales minus our cost of goods sold divided by net sales. And that gives us our gross profit margin ratio. Very, very good to know. Very important. Are there any comments, questions, or concerns about anything that we've just talked about merchandise companies? Anything at all? Y'all good? Okay.
Hey, Professor, it's Maxine. I'm still a little wonky on the acid test stuff, but I'll review it again. I'll read it again to determine where I feel like I'm stuck, and then I'll reach out to you then.
That sounds great.
All right, thank you.
Good plan. Thank you. And then if the rest of you are good, I just want to quickly call your attention to the classroom. We're in Module 2 now, okay? Module 2, Week 5. And then we have our Chapter 5 quiz that's due this Sunday night. Remember, there are 2 attempts that you have available to you for every homework assignment and every quiz. So if you're not happy with that first try, give it another shot, okay? I want to make sure you do the best that you can, yeah? So,
Professor, excuse me, I have a question. Do they have accounting programs on Cengage? Do you know?
not for this class, we don't. Cengage is a textbook. It's a textbook company. We don't have Cengage in this class.
Okay, just check.
Yep, no problem.
Sorry, Professor, this is Maxine again. One other question.
Yeah.
Is the quiz loaded already, or we have to wait until the 13th and take it?
Oh no, it's there. You can take everything in this class right now if you wanted to. Everything's available to you.
Okay, thank you so much.
Yep, you're very welcome.
Sure.
Any other comments, questions, or concerns? Okay. Well, thank you all so much for your time today. Sincerely appreciate all of your hard work, as I had said earlier. I'm really enjoying the class with all of you, and I hope you are as well. If you ever need anything, you can email me, call me, set up office hours, whatever you need from me. I'm here for you 100% of the time. And with that, I want you to stay safe, wash your hands, do the right things, and I'll see you all again next time. Appreciate all of you. Have a great rest of your night. Thank you. Thank you.
All right, Professor.
Thank you, Professor. Good night, Professor.
Good night.
Thank you so much. Take care now.
Thank you. Good night.
Right.
Night. Bye-bye.